Hi guys, in this video we are going to cover SEBI related current affairs for the month of February 2018. So as a part of our discussion we are going to divide this one into two parts, and this one is going to be the first part of our discussion. So friends, let's start with the first news item. Rules on cryptocurrencies should be out soon, SEBI chief. So this one is about SEBI and cryptocurrencies. So I believe you must not be relating the cryptocurrencies to SEBI as of now, but we have to analyze this one and understand that SEBI is also going to work on cryptocurrencies. Now why SEBI is going on to cryptocurrencies? Let us understand this. Now there is continuing volatility in the Bitcoin prices, and this has led to concerns about investors' safety. So there are some investors who have invested their money in the Bitcoins, and since the Bitcoins, they are highly volatile and the investors' safety is at stake, so SEBI is coming into picture. So SEBI chairman has said that regulations on cryptocurrencies should be out soon, and the role of various regulators that will play is being finalized. So it is being finalized what role will be played by SEBI, and this is not final as of now. What will be the role of SEBI? Now SEBI chairman is also the part of committee which is formed by the government to examine the pros and cons of virtual currencies. Now if we look at the virtual currencies, they are the digital currencies or those which are in digital or electronic format. Thus they are having different kinds of electronic risks attached to them. For example, they are vulnerable to hacking, they are vulnerable to loss of password and malware attack, which can result in permanent loss of money. So it's not like the money which you are having in your pocket, it's the money which you are having in your computer. So like the data which you can lose from your computer, the money you can also lose from your computer due to different kinds of threats. So this is something which is which is related to the safety of the money of the investors. So that's why different regulators are going to come into picture. And if we look at the present scenario, the Finance Minister of India has said that cryptocurrencies are not a legal tender. So this is the most important aspect as of now. But since many people, they are putting in money in the cryptocurrencies, there has to be some mechanism to regulate this currency. That's why different regulators are going to work together to frame a comprehensive policy. Next one is budget and corporate bonds. So corporate bonds, we understand corporate bonds are a kind of debt which a company has taken from the public. And what does the budget has to say with regard to corporate bonds? Now the finance minister in the budget has said that corporate sector should raise at least 1/4 of their funding requirement through bonds. So it says that companies, if they have to raise money, they should raise at least 25% of these money through the bonds. So this mechanism will involve raising debt, raising money through the bonds, and this we have already discussed in other current affairs video also, because this will help ease off the pressure on the banks which are already under the pressure of non-performing assets and stressed assets. So now the public will invest in the corporate bonds and the companies are going to get money for their different investment purposes. Finance Minister has also said that regulators in India permit bonds with the AA rating only as eligible for investment. Now it is time to move from AA to A grade rating. So AA grade rating is the highest, is the higher rating. Highest is the AAA, is the higher rating, and A rating is lower than AA rating. So earlier we are now focusing only on AA rating bonds, but the finance minister has said that we should move towards simple A rating bonds, so that our basket should be broadened and more companies' bonds will become eligible for issuing to public at large. The government and the concerned regulators will take necessary action in this regard, and necessary regulators, when we talk about SEBI, is the necessary regulator here, and hence this particular news has been covered here. Now let us also briefly look at the bond rating aspect of this news. Now bond rating means when you are giving a rating to a bond, when you are checking the credit quality of a bond, that whether this bond will be honored in future or it will not be honored by the company. So company has issued a bond, now company has to pay interest on the bond, and at the time of the redemption of the bond, when the entire period for which the bond was issued, for which the money was raised by the company, it ends, the principal amount has also to be returned. So we have to identify whether the company has the credit worthiness to do all these aspects to fulfill all its obligations on the bond. Now this one is examined by bond rating. So this bond rating system is going to help the investors to determine the company's credit risk. Now, when we talk about bond rating, there are two broad categories of international companies which are there, which are doing this thing, and there are different grading standards which they use. For example, if we talk about Moody's, the highest one is AAA, and here one also there is AAA, AAA, but they are using capital A's, and here they are using small a's, and this one is the highest quality. So you have to make sure, you have to understand that if it is written AAA, this means it is the highest quality, and as we reduce the A's, the quality is declining, though all are falling under the investment grades. Investment can be made in all of these bonds. However, when we move lower down the ladder, we move on to A, we move on to triple B, double B, and simple B. C is there, and also D is there. They are junk bonds. They are speculative in nature, and there are high chances that the company which is issuing these bonds, it may default in future, and the investors' money is not exactly safe in these kinds of bonds. Next is SEBI chief warns mutual funds are no substitute for bank returns. So I believe you all must be aware about the how mutual funds, they make you money, how you can put your money into mutual funds, and there will be a fund manager who will be there, and he will be managing all your money. But SEBI chief has said that they are no substitute for bank returns, because bank returns are more secure. In mutual funds, the returns may fluctuate and they are volatile. So in this sense, the SEBI chief has made this statement, but at the same time he has also pointed out that if you want to invest in capital market, rather than simply putting your money in a few shares which you are not aware of whether they are good shares or not, it's advisable you invest through a mutual fund. So if you have to enter into capital market, it's good if you enter through a mutual fund, and this is because the mutual funds, they are managed by professional investment managers who take the decision to invest your money according to proper financial management principles. So this is the structure of a mutual fund. There are investors. There are lots of investors who come together and they pool their money together, and there is a fund which is created by pooling this particular money, and there is a fund manager who is appointed to manage this particular fund. Now this manager is a qualified person. He is having all the requisite financial degrees so that he can make the appropriate decision in which shares the money is to be invested. So finally he makes the investment decisions and chooses the security in which the money is to be invested, and the return which is generated, it is used to give dividend to investors. At the same time, some amount is charged by the fund manager to meet its expenses of managing the fund. So this is how this broad structure of mutual fund is there. Next is SEBI may allow metal ETFs to attract retail investors. So here SEBI is thinking of allowing exchange traded funds. So this is important. ETFs are exchange traded funds. So for now you can simply remember that these are the instruments which are being traded on stock exchanges, and their prices, their value is going to depend on different kinds of metals like silver and platinum. So if you are able to invest in something whose value depends on silver and platinum, this will encourage the retail investors and even the institutional investors who want to get exposed to the price changes in these kinds of metals. They will not be tempted to make physical investment in silver and platinum and to keep them in a secure location. They will buy these securities, they will buy these contracts which will ultimately give them exposure to these silver and platinum. So this will give the investors the chance to participate in the market upside with lower risk and volatility and spread their risk in a better way. It would also make the price discovery mechanism of metal markets more robust. Now what this thing means? This means the investors, they are going to participate through these kinds of mechanisms, and since this is a regulated mechanism in which different kinds of stakeholders are there, SEBI is there, so it will be a more safer mechanism for investors. And at the same time, if more and more people, they are routing their money through the organized route, and when we have to analyze the demand and supply and determine the price which should be charged for silver and platinum, this would be more easier because now we are able to make sure how much actual demand is there for these kinds of commodities. So this would help in price discovery mechanism of metal markets. Now in the global markets, if we compare this to the Indian scenario, in global markets ETFs are based on equities, commodities and metals, but in India this basket is still on a narrow front, and these funds, they are broadly based on equity and gold only. So SEBI is thinking to broaden this particular basket. Now if you try to understand what are exchange traded funds. Now exchange traded fund, you can see like it's a amalgamation of mutual funds and stocks. It has features of both. Now exchange trading fund is a marketable security. It can be traded in the stock exchange and it tracks an index, commodity, bond, or a basket of assets like an index fund. So it's really simple. For example, if we talk about a silver exchange traded fund, this one is going to track the prices of silver commodity. So if you are giving yourself units, or you are purchasing units of this particular fund, you are going to experience the rise in the prices of these units commensurate with the rise in prices of silver in the market. So this is giving you exposure to silver, and at the same time there is a ETF which is based on, say, Sensex or Nifty. So what this does, this tries to duplicate the portfolio which is there in the Sensex, and by duplication it tries to track the movements in this portfolio. So if there is any movement in the Sensex, it is going to move up or down on the basis of movements in the Sensex. So if you buy units of this particular fund, you are going to get exposed to the movements in Sensex. So this will give you an exposure to a diversified set of portfolio rather than putting all your eggs in one basket. So this is how the ETFs or exchange traded funds, they work. Next is SEBI gets teeth to act against exchanges new market outfits. So this one is again related to the amendments proposed in the Union Budget 2018. Now, as a part of the proposed amendments, the government has given more power to SEBI. So SEBI is becoming more powerful. So SEBI is going to have the powers to impose monetary penalties on different market intermediaries such as stock exchanges and clearing corporations, and it is also going to act against newer categories of participants like investment advisors are there, research analysts are there, real estate investment trust and infrastructure investment trust. So new kinds of vehicles which are entering the market, and these are the terms which you will find in the newspapers day in and day out. So you will see that SEBI is going to get more power to act against these entities if they are not following the rules and regulations properly. Earlier, SEBI could only issue them warnings, but now there is a chance that SEBI may initiate penal actions against them, which may keep these market intermediaries in compliance with the requisite rules and regulations which have been framed for them. So now let's understand what is this increased scope of powers with SEBI. So the proposed amendments to the SEBI Act and the Securities Contract Regulation Act now allow the SEBI to impose a monetary penalty of at least rupees 5 crore. So it is at least. So minimum rupees 5 crore penalty can be imposed on stock exchanges and other intermediaries like clearing corporation and depository if they do not comply with the norms which have been framed for them. And the penalty, it can go up to rupees 25 crore. So 5 crore minimum, maximum 25 crore, or 3 times the amount of gains they have made out of such failure or non-compliance. So if they did not comply with any regulation and this resulted in a gain for them, so if we will try to multiply that gain by 3 and we'll find what was the amount gained, thrice the amount gained, and this will also determine the monetary penalty. So you can see how wide the powers are going to be with SEBI to impose penalties on different market intermediaries. Also, the amendments allow SEBI to act against the entities that furnish false or incomplete information to SEBI. Earlier, it could act only if the entity did not furnish information. So earlier, if there is a market intermediary, there is a clearing corporation who has to submit a return to SEBI and it did not submit, SEBI could only take an action then only. If it submitted but submitted incorrect information, SEBI's powers were limited. But now, SEBI has given wide-ranging powers to act against that particular entity in case of incomplete information also. Also, the whole-time members of SEBI have also been given additional powers to act against wrongdoers. So the basket of the powers of SEBI has been widened through these amendments proposed in the Union Budget. SEBI stock exchanges probe equity derivative trade violation of PSU banks. Now this one is a very interesting one. Now what happened, there was a fake circular which was circulated in the market and which was purportedly for misleading the investors. Now SEBI and the stock exchanges, they are looking into possible manipulation that could have been happened by this particular circular in the equity derivatives market of some public sector banks. So this fake notice was there, it beared the SEBI's logo and it was addressed to the National Stock Exchange, and it talked about different kinds of curves which are being imposed on the public sector banks. So this was about disrupting the trade in these public sector banks, and this was just a fake circular and there was no authenticity of this one. So that's why SEBI is trying to analyze how this fake circular came into picture and now what action has to be taken in order to make sure that the investors' money, it remains safe. Next is SEBI allows use of open market sale and qualified institutional placement to meet MPS norms. Now MPS norms, they are related to meeting minimum public shareholding requirement. Now as per the SEBI norms, every listed firm every listed company which is listed on the stock exchange, it has to make sure that at least 25% of its shares are held by public. So how to make sure that your 25% shares are held by public? There are different mechanisms of fulfilling this requirement, and now SEBI has widened this the use of mechanisms which can be made use of to meet this particular requirement. Now open market sale and qualified institutional placement can also be used to meet MPS norms. So SEBI has provided 2 additional measures to listed companies to ensure that they comply with this requirement. And the SEBI has allowed the use of open market sale, which involves promoters or promoters groups to sell up to 2% of the equity capital of the listed firm in the open market. So in offer for sale, in the open market sale, what the company is going to do, the promoters, they are going to sell their shares up to 2% of the equity capital of the company in the open market, subject to 5 times the average monthly trading volume of the stock. So these are some technical terms, and for understanding purpose we have to remember that using this open market sale, the promoters can reduce their stake in the company and they can sell the shares to public so that they are able to comply with this 25% public shareholding requirement. Now, and another mechanism is qualified institutional placement. Now in this mechanism, a listed company can issue equity shares and convertible securities in an easier way as compared to complying with the terms associated with an IPO and FPO, and it is relatively less expensive also. Now in qualified institutional placement, you need not come up with a public offer in which you are inviting the public at large to invest in your shares. In the qualified institutional process, which was initiated by SEBI in 2006, the companies, they can issue their shares to some qualified institutions who are qualified for this particular purpose, and this would allow them to meet with the MPS requirement, and at the same time they can get the required money at a lower cost than complying with the IPOs and FPOs provision, etc. Next is SEBI asks fund houses to disclose total expense ratio on a daily basis. So SEBI is trying to bring transparency in the mutual fund schemes which are there in the market, and in order to make investors more aware about the different aspects of mutual fund schemes, SEBI has come out with this proposal so that the fund houses, the mutual fund houses, they have to disclose the total expense ratio of all the schemes under a separate head on their website. Now this total expense ratio, it measures how much expenses the fund is incurring for generating money in the scheme which it is running for the investors. So it is simply a measure of the expenses which the mutual fund agency is charging for this particular scheme to the investors. So SEBI wants to make sure that investors, they should be aware about this particular thing, how much the expenses are being charged to this particular scheme by the mutual fund. And the investors, they should have proper knowledge, and the companies, the mutual fund companies, they have to communicate this to the investors through email or SMS about any change or increase in the total expense ratio charged to their schemes at least 3 working days prior to effecting such change, and it also has to be displayed on the website. So this is just a mechanism for promoting transparency in the working of mutual funds. Now if you try to understand the meaning of this total expense ratio, it is a measure of total cost associated with managing and operating an investment fund such as a mutual fund. So this is the formula of total expense ratio. In the numerator we are having total fund cost, and in the denominator total fund assets. So we'll see what are the costs associated with that particular fund, and we'll see what are the assets of that particular fund, and we'll divide the two. We'll get a number which will be the total expense ratio, that is how much of the expenses as a proportion of the total assets are charged by the asset management company to this mutual fund scheme. Now there are different components of this fund cost, and these components can be the management fees, the taxes, the trusteeship, the commission, the investor education expense, audit fees, marketing expense, etc. There can be different sets of expenses, and through this ratio we are trying to measure what are the different sets of expenses which are being charged to that particular mutual fund, and investors will also get the requisite information about what all expenses are being charged to the fund in which they are invested. Now next one is SEBI permits clearing corporations at International Financial Services Center to accept cash as trade collateral. Now there is a requirement that clearing corporations have to keep an appropriate trade collateral And these corporations, the clearing corporations, they are engaged in the clearance or the settlement of transactions which happen through the exchanges, and they have to make sure that the settlement happens in the actual terms and there is no default by the parties concerned. So this is why the trade collateral becomes important, and this collateral makes sure that the party in picture, the parties who are there in the settlement contract, they're having the requisite amount of money to settle that particular contract. So this is why SEBI has permitted the clearing corporations to accept cash as trade collateral. So now this is being allowed by SEBI, that the clearing corporations which have been set up at International Financial Services Center, they can accept cash and cash equivalents as collateral for trades in all product categories. So this is what was the news recently, and we have to know about this. And if you talk about the International Financial Services Center, this GIFT City, Gujarat International Finance Tech City, has been set up by Gujarat government as India's first IFSC, and SEBI in March 2015 issued a detailed set of guidelines for establishing international financial services centers. So this is about the clearing corporations. They carry out the different functions pertaining to the clearing, settlement, collateral management and risk management for various trading functions of the exchange. So whatever the trading is happening on this exchange, the buyer and seller, they are getting into touch with each other, but all the different kinds of settlement, the contracts of the shares buy and sell, they are going to be settled through this clearing corporation, and this is why this is a very important market intermediary in an entire trading transaction. Next is framework to ensure a smooth transition in mutual funds. Now, in order to ensure a smooth transition at mutual fund houses, SEBI has said that the new framework which it brought for regulation of mutual funds is going to be introduced in a phased manner, and there are some relaxations which are given in implementation of this particular framework. For example, SEBI has said that the auditors who have conducted the audit of a mutual fund for more than 9 years, they may continue till the end of 2018 and 19. And it has said that the requirement with regard to tenure of independent trustees as well as directors will also be complied with in a phased manner within a period of 2 years. So there are some relaxations being provided by the SEBI in the new mutual fund regulations which are issued by it. So what were the new norms which were issued by SEBI for mutual funds? Now, as per the new norms, an independent trustee, an independent director and an auditor, so these are some of the important offices associated with the mutual fund. They can hold office for a maximum of 2 terms, with each term not exceeding a period of 5 consecutive years. So they can hold the office for 2 terms for 5 years each. Such entities will not hold the office for more than 2 consecutive terms. However, they will be eligible for reappointment after a cooling off period. This means they have to remain separate from this particular fund house for at least 3 years, and then after 3 years they can again become the independent trustee as well as an independent director, and 5 years for auditors. This framework, these were part of SEBI's efforts to strengthen the governance structure of mutual funds. So SEBI wanted to make sure that there are some rules and regulations with regard to the important persons who are managing the mutual fund. So that's why these were introduced, and these allow for different kinds of rotations of auditor, rotations of director and trustees, so that the fund continues to operate in a transparent and an efficient manner. Next is mutual funds cannot charge expenses in lieu of exit load. Now, whenever we talk about the expenses associated with mutual fund, this exit load is an important term associated with that. Now, when you enter a mutual fund, there is this entry load which is charged as a processing fee for making you enter into the mutual fund, and when you exit this mutual fund, there is an exit load which is charged maybe as a penal charge or as an processing fee, so that you can exit the mutual fund. So SEBI has issued 2 circulars and has said that expenses in lieu of exit load will not be allowed for close-ended schemes, and the incentives which are being given by SEBI, they are going to be restricted. Now, when we talk about the schemes of mutual funds, there are either open-ended mutual fund schemes and close-ended mutual fund schemes. In open-ended schemes, you can enter or exit any time from the mutual fund. You can sell your units back to the mutual fund, and you can exit the fund. And in the close-ended scheme, the mutual fund does not accept the units which have been issued. You have to sell those units in the market. So that's why SEBI has issued the circular that expenses in lieu of exit load, they should not be allowed for close-ended schemes, because they are not actually allowing the investors to return money to the fund, and the investor is getting liquidity for this particular units from the secondary market. Now, this is a topic for discussion in detail for some other time. As of now, we have to understand that this exit load, SEBI is against it, and SEBI is also allowing the incentives which were earlier allowed for top 15 cities, now this is being expanded to 30 cities. Now this may give you a false impression that SEBI is allowing expenses for more cities, but this is not so. Now what happened? Let us understand that SEBI, in order to increase the penetration of mutual funds, allowed the mutual fund houses that they can charge additional total expense ratio of up to 30 basis points for the top for working beyond the top 15 cities. This beyond word is very important here. If you are selling your mutual funds in other than the top 15 cities, you can charge this additional total expense ratio, because it might have been very difficult for the mutual funds to service the non-big cities, the smaller cities at the same cost, because it would have been difficult for them to reach the investors and convince them for investing money through the mutual funds. So that's why SEBI has allowed this, that they can charge more if they are going beyond the top 15 cities. But now there is this change which has been made, that now the mutual funds, they can only charge more if they are going beyond the top 30 cities. So for now, top 30 cities, there is not going to be any additional total expense ratio. Only if you are moving beyond the top 30 cities, then only you can charge this additional expense ratio. So this is the change which has been made. Now if you try to understand how the mutual fund schemes and expenses they work, now currently the fund houses, they charge a maximum of 2.5% of the asset under management for managing an equity scheme. So we understood that there is a fund manager for a mutual fund, and there are some expenses associated with managing the fund, and for this particular purpose there is some amount which is charged by this fund manager. Now on the top of this 2.5% which is charged, there is 20 basis points charged as an exit load, and 30 basis points for promoting mutual fund penetration in small towns. Now this has made India's total expense ratio associated with the mutual funds very high, around 2.2%, which is among the highest in the world. So SEBI now wants to rationalize this total expense ratio associated with the mutual funds, and in this direction SEBI has issued these new norms, so that the asset management companies, they will only be able to charge the additional 30 basis points now if 30% of their gross new inflow in the scheme, or 15% of the total asset management, it comes from beyond the top 30 cities instead of beyond the top 15 cities. So if their substantial portion of the new scheme is coming from beyond the top 30 cities, then only you will be able to charge additional expenses as a part of the new SEBI norm. Now next one is a very simple one. SEBI and stock exchanges are there. They are going to work together to improve the risk management surveillance system. Now this one was in the wake of global stock market rout, which was there was fears that this may spread to India also, and the Indian stock prices, they can decline. And in order to prevent any mishap in the Indian stock market, the SEBI and the stock exchanges, they came together and tried to introduce this risk management surveillance system, so that they can provide a shelter to the Indian securities market from the global economic scenario in which the stock prices, they were on the trend of declining. Also the investor sentiment was also sluggish. It was not on the good side, as the government introduced some new budget proposals to levy 10% long-term capital gain tax on equities. So this was why they were framing up a new risk management surveillance system. We have to just understand how SEBI is concerned with the risks in the stock market, and how it can come up with different kinds of management surveillance systems to ensure that the investors' money, it remains safe, and the Indian stock market, it remains stable. So now let's discuss some of the MCQs based on our discussion. Which of the following is correct with respect to cryptocurrencies in Indian context? They are stored in digital or electronic format. Finance Minister of India has said that the cryptocurrencies are a valid legal tender. Both are correct. None of the above is correct. So friends, this we have learned that the Finance Minister has said that the cryptocurrencies are not a valid legal tender. So the correct answer is going to be option number A here. Next is, which of the following bond rating denotes the highest quality of bond instrument? Options are AAA, AA, A, or all of the above. So this we have seen that the highest one is AAA. So answer is going to be option number A. Next is, which of the following may be tracked by an exchange traded fund? Options are index, commodity, bonds, or all of the above. So we have seen that an ETF can track all of these. So the answer is going to be option number D, that is all. Next is, which is incorrect regarding qualified institutional placement? SEBI introduced the QIP process in 2006. For the issuing company, the QIPs are less cumbersome than IPOs and FPOs. It is a mechanism whereby a listed company can issue equity shares and convertible securities, or all are correct. So this also we have understood about the qualified institutional placement, that all these statements they are correct. So the answer is going to be option number D. So friends, these are the answers. So friends, this was all about the first part of our discussion on the SEBI related current affairs for the month of February 2018. Thank you.